All right, well, welcome everybody. Today's Winning on Wednesday webinar. Today we will be talking about due diligence from a tax and accounting perspective. My name's Kristen and I'm the digital marketing specialist for Wegner CPAs and your moderator for today's webinar. During the presentation today, any questions can be submitted through the Q&A feature at the bottom of the screen. I'll be keeping an eye on that and we'll try and address your questions either during or after the presentation. The session is being recorded and I'll email that to you after today's event along with the PowerPoint slides, and it will be available on our Wegner CPAs website as well. Our speaker today is Dan Bergs. He's a senior manager at Wegner CPAs. Dan, I will turn things over to you.
All right, thanks, Kristen. So just a reminder, everybody, this Winning on Wednesday seminar, we do this every 3 weeks. It's a half-hour presentation just to help share some good information on businesses that are looking to potentially sell and business transitions and succession planning. So we're brought to you by Wegner CPAs, by Action Coach, and by Triumph Wealth Management. So just a reminder to everybody, it does take a team. You work with different advisors. Every advisor has a role in helping your business transition successfully. Periodically, you've got individuals listening to this that are advisors themselves. So everybody kind of knows their individual role. And our goals with Wegner, Action Coach, and Triumph, all of our goals are really to help our clients transfer their businesses successfully and retire in style. And kind of when we were talking originally about, taking a little bit of history on this seminar and kind of the group of people here, the one big thing that we want to see is we want to see businesses continue. We don't want to see businesses get to a point where someone's ready to retire and they shut down the business and it goes away. Our goal is to help as a team of advisors for businesses to continue so business owners can sell their businesses, whether that's to existing employees, gifting to family members, selling to a third-party competitor, whatever it might be. We just want to help business owners successfully transfer their businesses so that their businesses can continue. So due diligence is the topic today. We're going to talk about that a little bit from an accounting and a tax perspective as well. So if you don't know what something is, what's the best way to find out? You Google it. So here's the definition of due diligence. Due diligence are reasonable steps taken by a person in order to satisfy a legal requirement, especially in buying or selling something. Can include a comprehensive appraisal of a business undertaken by a prospective buyer, especially to establish its assets and liabilities and evaluate its commercial potential. So this description is pretty spot on, obviously, because it was Google. But this description is pretty spot on as far as, what really is due diligence. When you kind of break it down, it's essentially a prospective buyer of a business looking into a prospective seller of a business and trying to determine what is that business worth? Are this business's assets and liabilities on the balance sheet legitimate? Really just kind of digging in and figuring out, is this someone we really want to purchase? So when would a company have to do due diligence if you're planning to sell your business? There's certainly several scenarios. Each scenario kind of changes a little bit depending on what type of scenario you're looking at for selling. Certainly the level of detail and cost typically depends on the prospective buyer, and it also does depend on the seller. The larger the company that's selling, probably the more due diligence the buyer is going to do because the sale amount oftentimes is going to be larger. For a smaller sale amount, there's not going to be as much due diligence done in a lot of cases, simply because the cost benefit analysis maybe isn't worth it to dig into due diligence significantly. I can share with you, worked on a deal last year and the company sale was right around 5 million. The buyer had some large private equity that was backing them, and their acquisition cost to acquire that business were over $200,000. Now I know that seems like an astronomical amount. They had a lot of due diligence that was done as part of this process. And they have a large team of advisors that they were working with on the buyer side. So when you're working with a private equity company, that would be a third party buyer, and that's probably the most detailed scenario. So third-party buyers, private equity companies, it could be a competitor that's looking to purchase your company. It could be, it could be an existing company that's not active in your region yet. And maybe they want to acquire your location, acquire your team to expand their operations. Those are all kind of third-party buyers. And the due diligence for them is certainly going to involve more. And they're likely going to involve a third-party CPA firm to complete due diligence for tax and accounting. So, what does that mean? They're going to do due diligence on tax. They're going to look at what elections you have for what type of entity your business is. They're going to make sure that, all the I's are dotted, all the T's are crossed, that you've got all the correct filings with the IRS for those entity elections. They're going to look at the tax returns. They're going to look at things like Nexus, and we'll talk about that in a little bit here. But they're really going to look at everything. And what they're trying to do is essentially they're reporting to this potential buyer on your company, and they're reporting, kind of what grade would they give your company, what risks are out there, what potential liabilities are out there as a buyer that they want to try to avoid, or that they can maybe build into a purchase agreement to make sure the buyer may not be liable for some of these things. On the accounting side, they're really looking at your financial statements. They're looking at, depending on what type of industry you are, if you're manufacturing, maybe your distribution, maybe your construction, you've got a margin on your jobs, a margin on your products that you're selling and producing. Professional services, they're going to look at, what's an hourly rate that you have for your company? How much do you profit on each account in different professional services industries? They're going to be looking at all of those things and try to determine, what is the real value and how much are you making on those? Because as another company that's acquiring you, oftentimes they're larger and they can scale more things where they know what their costs are in other areas, but knowing those margins that you have are going to be valuable for them to determine how much are they going to make after purchasing your company versus what are you making right now with your company. So as I said, they want to make sure you're compliant from a tax perspective. They want to make sure your financial statements really accurately reflect your operations and that you understand your financial statements. There are other areas of due diligence as well that certainly can be done. And with larger purchases, there are other areas that are done. They look at the benefits your company might be offering. They look at technology. They'll look at your internal controls that you have within your systems. They want to look at what software are you using. Is it the same software as them? Is it different software? Are they going to have to convert things and make a lot of changes on a technology side? And certainly environmental aspects, environmental remediation. Is there anything else that may need to be done from that perspective based upon where your facility is located? So these are all things that can kind of factor into a due diligence process. So some other scenarios where due diligence kind of looks a little bit different. If there's internal purchases by key employees, it depends on the scenario. A lot of times they're not going to go hire a third-party accounting firm to come in and look at everything. Those key employees a lot of times already have access to financial statements. They already, can get access to the tax returns. They're talking with the current owner already as part of the management team and helping make those decisions. So they feel a lot more comfortable about the operations of the company. Certainly family business transfers to other family members. You may be, gifting or selling part of a business to family members. And, in most scenarios, those family members are working in the business in some way, shape, or form. In some scenarios, maybe they're not working in the business and they're deciding to invest in a family business. They may want to hire someone to do a little bit of due diligence on their end to make sure that financials in the company is being run smoothly. I'm sure they trust their family members, but whenever money is involved, they always want to make sure they're making the right decisions. And Nathan had a seminar, it may have been a couple months ago here, I believe, on ESOPs. So certainly you can refer to that for more information on ESOPs, but those are employee stock option purchases. And that's essentially where the company is selling to all of the employees. And that process involves a lot of due diligence. And then that also involves a lot of, we'll call it annual maintenance that needs to be done as part of those employee ESOPs. So internal purchases, oftentimes, there's an agreed upon amount that likely relates to either a business valuation or something that the key management members agree upon with the current owner. In most cases, we recommend business valuations get done so you truly do have a good value of the business, so that the owner and the key employees both feel comfortable with the price of the business. There certainly are cases where an owner for a business may just look at a balance sheet and say, here's the book value. And what that means is that's the assets minus the liabilities. That is a book value of a company. And I've had several cases with owners where they have just said, just pay me the book value, I'll walk away and you can take over. That's generally a very favorable, from a key employee purchasing the business, it's a really favorable option typically. And in other cases, there's maybe different multipliers or things that key members and an owner of a business would agree upon for purchasing the business. But we typically recommend, get a business valuation. You've got a third party evaluating the business to tell you really what it's worth. And that's going to be the best piece of information for an owner and for key employees to really talk about, whether they agree upon that price or that's kind of the price that's brought for negotiations. Another situation here is a family transfer. This is going to require business valuation to calculate the gift. Most commonly in family business transfers, it's mom or dad transferring down to their kids. In some situations, it's to grandkids, depending on the age of the owners and their family dynamics. But most of the time, they're not selling for the full market value when they're selling it to family members. Typically, a portion of this is going to be gift. And when there is a gift to a family member, typically you're not doing as much of this detailed due diligence, but what you would need done is you would need a business valuation done to value what that gift is worth. And that gift would be from one family member to another family member. And the purpose of that business valuation is to calculate the value of that gift. And the individual giving that gift has to file what's called a gift tax return and use up part of their lifetime exclusion. This is just kind of a side note. This is certainly a hot topic right now in the tax arena, as well as the estate planning arena, because right now there's over like an 11.5 million exemption per person before they may be subject to estate tax. And that's set to go down. There's certainly proposals out there. And what we've been hearing right now is probably somewhere between 5 or 6 million that estate exemption is going to go down to. So if you're someone that has assets of 10 million right now, then you're below that 11.5. But if the estate exemption goes down to 5 or 6 million, you may seriously want to consider potentially gifting or getting some assets out of your estate right now before the exemption is reduced. So that's kind of another planning item that we're evaluating with a number of clients right now. I've got 2 clients right now that are going through some gifting and getting valuations in order to help reduce their estate. So how would I describe the due diligence process? I think this is kind of the best way that I can describe it. When a buyer's looking at a business, they see a shiny new car that they want. You see all the good stuff when you're looking at acquiring the business. You see good financial statements. You see profitability. You see something that can help expand your business operations, something that's going to make you worth more. Once the due diligence process starts, they look at everything under the hood. So when you're going through this process, there's a series of inquiries and a lot of meetings with third-party due diligence teams. They're going to have a series of questionnaire. They're going to have a series of items that they're asking for. They're probably going to have some sort of portal for you to upload documents and kind of complete things through a checklist. So there's a lot of information that they ask to add to their files. Because, if you kind of think about it from the standpoint of a CPA doing due diligence on a company, if someone's engaging me to do due diligence on a company, I want to know a lot about that company. I want to acquire as much information as I can so I can give my client the right information to make a decision. And this is a very detailed process. Oftentimes it can take anywhere from 30 to 60 days to go through these engagements. So what does that mean? If you get a letter from a private equity company today, and they send you a letter of intent, they want to purchase your business for, we'll pick a number and say $5 million. They want to buy your business for $5 million. If you see it, you think that's a great deal, you want to sell your business, you talk with your advisors over the next couple of weeks, you send it back and sign it and say, here you go. Go ahead and let's start working on a purchase agreement to buy my business. They're probably going to send something back and say, all right, we hired ABC company to do due diligence on your business. And let's say the timing is you get something today, you send it back in a couple weeks, they get it early October, they get an engagement team ready by mid-October, and you've got due diligence going through the end of November for a prospective closing date for the business. Now, these are pretty quick processes, and I know 30 to 60 days seems like it can be a long time, but it is a fairly quick process, so it's pretty intense. And the key for this process is to be patient. They're going to ask a lot of questions, and sometimes the response, you may even feel a little bit offended about, why are you asking me about why I do it this way? No, it's my business. This is how I'm running my business. So certainly be patient. It is a long process. They dig into a lot of detail, and it can consume a lot of time. So it certainly is a stressful process for a business owner, because again, they see that shiny new car. Now they're looking under the hood at everything in your business. So I think the best advice I could probably give is make sure you get the right people on your team involved and use the correct advisors during this process. And the reason for that is, I've had a couple situations recently where one of them, they involved their general manager and their internal bookkeeper. And they really took those two people as the people involved in the process for due diligence. And they trusted a couple of their employees to be part of the process, knowing that there certainly is risk. If you're looking at potentially selling your company, you don't always want to tell your employees, hey, I got a letter of intent to sell the company, so I might be selling. That can result in potentially a lot of uneasiness and potentially a lot of turnover. And that's certainly scary for a business owner if you think about some of your team members leaving because you might be selling a business. So having the right people involved internally and making that decision, whether you want to have anyone involved internally. I had another client fairly recently, they sold their business and they decided to just use advisors. So as their accounting firm, we were very heavily involved throughout that process. And they decided they were going to value using advisors only to make sure that this deal was actually going to go through, so it would actually reduce their risk of having employees potentially leave because they were working on selling the company. So it really depends on your business, depends on who you have involved with your management team, whether or not this is something that you want to do yourselves with your advisors, or if it's something that you want to handle with your internal management team. Although even if you have an internal management team, always keep your advisors involved, because there's a lot of tax planning and opportunities that you can have and making sure that you get the agreement drafted best for yourself as a seller. So how can I prepare for this due diligence process? What can you do today if you're thinking about potentially selling your business? There's a number of things you can do proactively, and I'll kind of walk through them here. One is written accounting policies and procedures. This probably sounds like a dream as an accountant, and it is, but probably not a lot of businesses have this. When you have written policies and procedures and you've got manuals, I know it takes time to compile those, but they are really, really valuable, even if you're a controller or if you're office manager or your HR director, whatever it might be. If that individual is leaving your company, having these policies documented is really valuable just for really congruency within your company, but also for a prospective buyer to know that you are very well organized and you have these procedures in place. Have a record retention policy and keep organized documentation. This is a big one as well. During the due diligence process, you get asked for a lot of paperwork. They'll probably ask for, they want the original letter when you got your employer ID number. if you're an S corporation. They want a copy of your signed S corporation election. They want a copy of the IRS's confirmation that you're an S corporation. They want copies of all of these election forms. So all of these, we call them permanent file or perm file documents. You want to make sure you have those organized in your records. And ideally, in the age that we live in right now, ideally you do have electronic records for all of these items. And if you have currently a paper system, we always recommend converting paper systems to electronic. It's going to help keep things more organized. It takes time and patience to get there. But once you're there, we really are in an electronic world. And having electronic documentation is really going to be beneficial for your business in the long term. You want to have clean financial statements. These could be audited, reviewed, or compiled by an independent accounting firm, or they could be prepared by your accounting department internally. But you do want to have clean financial statements. You want to have an understanding of your financials, because that's going to be one of the huge things that a third party is going to dig into in this due diligence process. They're going to look at, what are your margins for your company? What is your rate per hour if you're a professional service time company? What type of assets do you have? They really are going to dig into your financial statements and understanding those and making sure you've got revenue reported properly and expenses reported properly is going to be a big part of what they're evaluating. Now, certainly know who your trusted advisors are and who your trusted team members are to assist. We talked about this previously, but know your advisors, know what team members you have, know who you can trust and who you want to be part of this process. And even think about this periodically. Who are your advisors? Who are your team members? Are you all on the same page? Certainly, that's one of the reasons we're doing these seminars. Nathan, Susan, and I, our team, to make sure that our clients are on the same page with their advisors. Reevaluate Nexus. I brought this up earlier a little bit, but Nexus, this determines your filing requirements for sales and or income tax based upon your economic activity and physical presence in other states. So I'm located in Wisconsin, our firm's located in Wisconsin, but we have employees that maybe are in different states. If we have employees in different states, at Wegner, we have Nexus because we're doing business in those states. We have people physically present in other states. And in those situations, when you have that, you are going to trigger a filing requirement for income tax purposes in those other states. For sales tax, maybe you're a manufacturer and maybe you attend a lot of trade shows in certain states and you're really doing heavy business in those states. If that's the case, you may have established a physical presence in those states or economic activity in those states, and you may trigger a filing requirement. So reevaluate this because this is part of the tax side of this due diligence. Just looking at, do you have the correct state income tax filings? What exposure might be out there as a prospective buyer? And then certainly you want to schedule due diligence time. Scheduling time for due diligence is a really effective strategy to make sure you turn everything around promptly. So if you're going to be part of a due diligence process because you are going to sell your business, you want to schedule at least a couple hours, probably a couple times a week, maybe 2 or 3 hours, 2 or 3 times a week. I know it sounds like a lot, but schedule that time ahead of time so that you do have time to turn things around quicker. Because the longer it takes for you to turn something around at a company to a third party doing due diligence, the more it can delay the potential selling of the business. And you want that timeline to be really as close as possible, because as things get delayed, things get pushed back, it does cost you more as a business owner. So that is everything I have for today on due diligence. Coming up next, Susan's got a presentation on October 13th, so 3 weeks from today. And just a reminder, if you have any questions for any members of the advisors here, I'm certainly happy to answer those. We've got my contact information here as well as Susan's and Nathan's.
Dan, great job. Just to follow up on a couple of things you mentioned and to underline and underpin them for you is a recent example I can think of. I have a 16-year-old teenage boy, and his definition of a clean room versus my wife's definition of a clean room are not the same. They both look at it the same, they use the same words, but they're not the same. And that's kind of how I look at it as due diligence. And we've talked about this before in what we call the ugly baby syndrome. Your baby is not ugly, but it's going to feel that way at times. And people are going to walk into your room and say it's not clean, if you will. So be patient with it. And Dan mentioned this, but due diligence does take a lot of time. So we've seen a lot of business interruption occur through that process, even some stagnation. So just be aware of that. It's a normal part of the process. And I know that Wegner CPA can help you walk through, we'll call it the fire drill of go through the pre-work of a due diligence process. That'll make it much, much easier for you, and quite frankly, could take some of those emotional pain points away when you're in the middle of that process. Because it is a very emotional time, and people look at it differently. But Dan, thank you again. You did a great job, but I just wanted to underline that it does take a lot of time and a lot of resources on behalf of the seller. And in many cases, the buyers are in control. They're the ones driving that process. But the more you're aware of it, I think the better you can prepare your business and yourself for that process.
Thank you, Nathan. Really good points.
Thank you so much to Dan and Nathan for sharing your expertise today. We certainly appreciate it. Everybody can keep an eye out for an email from me with the recording from today's session, as well as a link to register for our next session that will be presented by Susan. We hope to see you all again in October. Thanks and have a great day.